Good morning. Welcome to Stock Market Today for Wednesday, November 28th, 2018. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can follow me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics in conjunction with StockCharts.com and Stock Charts TV. And you can sign up to receive a free email. Follow along with this show and receive free stock ideas every day. Head over to ChaikinAnalytics.com/today. U.S. markets were mostly higher yesterday, but for the Russell 2000, which closed lower by about 87 basis points. Healthcare and defensives were the best performers. Materials was the biggest underperformer as commodities remain weak. Treasuries were little changed to slightly stronger. The dollar was stronger on the major crosses. Gold finished down 70 basis points. WTI crude settled down 10 basis points, but well off the worst levels of the day, following a gain of nearly 2.5% on Monday. And as we get to the desk here this morning, S&P futures are up 40 basis points after finishing higher in back-to-back sessions. Asian markets were higher overnight, with Japan, Hong Kong, and China all up over 1%. European markets are higher as well. Treasuries are unchanged to slightly stronger at the long end of the curve. Dollar is little change versus the euro and yen, but lagging on sterling. Gold is weaker, and WTI crude is up 10 basis points. So we string together a two-day rally here, but not a ton has changed. Support remains in the 2570 to 2600 zone. Resistance comes into play near 2700. RSI remains in bearish ranges, but we're calling out these positive divergences at the recent lows as a potential bullish sign in the near term. And in my note today, I take a look at the bullish divergences, not only for the S&P 500, but for the IWM, representing the small caps, as well as the Qs, the QQQ, really the names that kind of got us here, if you will. Chaikin money flow stays bullish, and it's actually moving higher here as the market rallies over the past couple of days. So some positive developments on the indicators that may be pointing to a less intense low here on a closing basis, with the sell-off during the Thanksgiving week potentially setting us up to rally further. Onus is still on the bulls to continue to hold these support levels and start to push the market through key resistance. But for now, we're starting to see some positive developments. So we'll continue to watch those closely, but they are starting to take place, so I wanted to call them out. Our market in a minute, what I'm talking about in my note today, S&P 500 rallies for a second consecutive day. We hit on that. Small caps underperformed, but are holding support at the October lows, and I think that's important. Sentiment is still more fearful than greedy, and that could potentially provide some contrarian fuel for a rally into year end should price start to cooperate, and futures do point to a higher open here this morning. Looking at the power bars for the major indices, the Dow, 6 bulls to 5 bears, so an uptick from yesterday. S&P 500 upticks as well. 67 bullish or very bullish stocks, 88 bearish or very bearish stocks. NASDAQ, not much of a change, 13 bulls to 20 bears. And here's your small cap underperformance. While all the major markets, the other major markets, were higher on the day, small caps underperformed. 174 bullish or very bullish stocks, 479 bearish or very bearish stocks. Slight uptick in the price of bonds sends yields lower. And there's healthcare outperforming on the day. 13 bullish or very bullish stocks in healthcare, 3 bearish or very bearish stocks. Remember, this is a group that we've liked, in particular the larger pharma names as well as the services companies. According to the Chaikin Power Bar, small cap stocks are more bearish than large cap stocks, and major indexes are mixed. Turning now, speaking of healthcare / retail, our stock of the day, if you're following along in that email, CVS Health Corp comes to us from the Food and Drug Retail Wholesale Group. CVS is the ticker symbol, has a very bullish power gauge rating due to very strong earnings performance, attractive financial metrics, strong price volume activity, and positive export activity. This one really lines up well when we look at it from a factor standpoint, up 2.13%, so a nice outperformer yesterday. When we look at the chart and run through our analysis, very bullish stock, strong trend, weak industry. Ribbon at the bottom of the screen here tells us where we are and where we have been, and we've really been bullish since about the June-July timeframe. But the market model took about a month to get into gear, and in early August, CVS started outperforming the broader market. So now the dynamic duo are in gear, market and model are in agreement. We have CVS approaching oversold levels. Money flow is neutral, but we are above that rising long-term trend line. I think there's a couple ways to look at this. I think you can get involved here. I think the setup is compelling. If you want to wait for a breakout through the $82 level, some folks like to see stocks break out of ranges before they get involved. I can't argue with that mentality either, or some sort of hybrid, maybe buy a half a position now and buy the rest on a breakout. But we are oversold. I think the setup does look compelling for CVS. I think it's important to just figure out the strategy that works best for you and your style, but this is certainly the type of name that we want to consider on the long side of the portfolio. Taking a look now at our sector tracker, the movement over the last 5 days for the major sectors, you can see a little bit of a risk-on mentality here. Some positive commentary out of the holiday shopping season, sending some of the discretionary names higher. Comms rebounding a bit. Technology rebounding as well, and healthcare rounds out the top four. Bottom of the list, materials. Remember, when materials were rallying last week, and we were up in kind of the middle to higher end of this list, we called it counter trend in nature. They are beginning to roll over again. Energy continues to be under pressure with oil. Utilities giving some back a bit. Remember in my note yesterday, I talked about the fact that the defensive names on a relative basis did look a bit extended and we're due for some consolidation. I think that's what we're seeing here in the staples, REITs, and utilities. Turning now to our industry in focus. It's one that we have been bearish on, and it's been a good call. Home builder services. 1 bullish or very bullish stock, 9 bearish or very bearish stocks, and over the past 6 months, the home builder subsector has underperformed the S&P 500 by nearly 10.5%. And its power bar ratio, which measures future potential, is very weak, with more bearish than bullish stocks. Currently ranked number 16 of the 21 subsectors that we track. It has moved up actually 5 slots over the past week. Some of the indicative names in the group to consider on the bearish side. USG has a very bearish ratings, but there's some special situation activity going on here, so let's throw this one out. Leggett and Platt, LEG, very bearish rating, and iRobot, ticker IRBT. Those are the makers of those Roomba vacuum cleaners. I have to be honest with you, I kind of want one, but that doesn't mean that it is a stock to consider. I like the product, don't necessarily like the stock. But let's look at Leggett and Platt here, because I think there's a compelling setup for investors who trade to the bearish side of the ledger. Leggett and Platt has a very bearish rating. Weak trend, weak industry group. So what do I say? We're fishing in the right pond. This is the type of name that we definitely know we don't want it in the portfolio, and certainly might want to consider opening bearish positions if the opportunity presents itself, and I think it does. Ribbon at the bottom of the screen. Where is that power gauge rating now, and where has it been over the past year? You can see that this really has all the makings of what we like to call a Chaikin classic bear. I like to say that the bottom of this chart looks angry, right? A lot of red at the bottom of this chart tells you at the very least you don't want to own this stock. But what we have is a very bearish stock that's underperforming the market. So market and model in agreement, dynamic duo are in gear. And here's the setup, right? We know strategically, bigger picture, this is a name we want to avoid, but here's the tactical setup. Stock is currently overbought with bearish money flow, rallied back into the middle of our volatility bands below a falling long-term trend line. I think that the opportunity is there to open positions to the bearish side, whether that's shorting the stock outright or looking at potential plays using options that make sense, outright puts or a bearish vertical put spreads. But at the very least, we don't want to own Leggett and Platt, and we certainly want to consider bearish trades. Turning to yesterday's S&P 500 movers. On the gainer side of the coin, PCG up 7.36% as investors continue to wade through the potential liabilities of the fires out in California. No company-specific news on AMD, but some positive commentary out of a report that AWS, that's Amazon Web Services, potentially using ARM-based chips, and AMD has some exposure there. So that sent that stock higher, but keep in mind that is a very bearish stock. Vertex, VRTX, up 4.8%, reporting some early results on one of their cystic fibrosis studies. Investors like what they heard there. McKesson, part of that healthcare services industry. These are a drug distributor. Those are the names that we continue to think or have been continuing to outperform the market. Healthcare had a decent day yesterday, and in particular, the hospitals and services. And Macy's up 4% following some positive commentary on Jim Cramer's show about some high-quality retailers. Sends that stock up about 4%. On the loser side of the board, APTV down 4.5%. No real news there to speak of. UTX, bearish stock. They're splitting the company into 3 distinct companies. Investors take 4% out of the name there. No real news on Huntington Ingalls, HII, to send that stock down 4%. NFX, just kind of an example of what we talk about when we're trend followers. Stock making 52-week low, week get weaker, down 4%. And Ralph Lauren down 3.85%. This stock has been under pressure since reporting earnings. And I will note, remember when Ralph Lauren reported earnings, we talked about some of the names, high-end retail consumer names that have exposure to China coming under pressure. And I said, take a look at Tiffany. Well, Tiffany reported. Stock was trading down this morning in the pre-market. So that theme continues to play out. Let's look at what we're talking about today in the note. Small caps underperformed on the day. So here's that chart, the IWM relative to the SPY, and we can see the breakdown, but we're trying to hold support. Notice, remember, small caps were the laggard on the day yesterday, but we did not break support. We're kind of holding around this support level. We are below the 200-day moving average. But what's interesting to me is that on an absolute basis, the IWM is holding those October lows. I think that that's important as the market tries to stabilize. We want to see small caps kind of start to outperform. Remember, they led to the downside. Here was the peak in the small cap relative performance long before the market broke down in the September-October timeframe, and then small caps actually just participated to a greater degree to the downside. But one of the data points that we're looking at is for small caps to stabilize and begin to move higher. Now, again, remember I talked about in my note today, we're starting to see some divergences in the main indexes from a momentum standpoint. That's one of the things that's a highly important aspect of the market that we're looking at, but we need to see a confluence of data points. The other data points that we're looking at are small cap performance relative to the market, performance of semis relative to the market. We talk about that in our note every Friday, but just kind of keep an eye here as small caps try to stabilize on both an absolute and relative basis. I spoke about sentiment still being more fearful than greedy. Here's a 13-period moving average of the CBOE put-call ratio, and it's unchanged from last week at 1.02, but it is still elevated. Now, above 1.1 are signs of capitulation and tradable lows in the market. You can see we did have that back in the early October timeframe where the market rallied. Now what we want to see is investors start to come off the fear. But while investors are still more fearful than greedy, that could provide a contrarian counter trend lift into the end of the year. I say it could. Obviously, nothing is guaranteed, especially in the markets. But sentiment is an important aspect of our research process, and we do keep an eye on it on a daily basis, and we publish on it every Wednesday. One of the key themes, however, that still points to that fearfulness in the market is the outperformance of low volatility relative to high beta. This chart shows us the SPLV relative to SPHB, so the Invesco S&P 500 low vol ETF relative to the high beta ETF, and you can see it's broken out to 2-year highs, slight consolidation, and now running again above the 200-day moving average. RSI of that ratio shifting over the course of 2018 into bullish ranges. Investors continue to position defensively, and part of that defensive positioning is favoring low beta stocks over high volatility stocks. I think this is a trend that looks like it's likely to continue in the near term, and here's why. Here it is in a Chaikin chart. SPLV has a very bullish rating. It's been outperforming the market since October. It's oversold. It has bullish money flow. Notice that as the rest of the markets pulled back to test their October lows, here last week, SPLV held its own. That's what we talk about when we talk about relative strength and looking at the parts of the market that hold up when the market sells off. SPLV is that theme playing out here for us in the current market environment. So that's it for today. Sign up for that email. Get daily stock ideas for free, and you'll follow along with this show. Head over to ChaikinAnalytics.com/today. I will see you here tomorrow at 9:15. Have a great day, everyone.